that the economy has been weak in the first quarter.
Meanwhile, the FOMC did repeat their comment that with appropriate firming in the stance.
Oh man, can everybody see me? Has everybody got my video okay? Is it all up? Can everybody see my video? Let me know if my video is up. Had a few technical issues, but we are up. It's been a 50% increase, right, guys? 50 basis points, exactly as expected. Let's head on over to the charts. Hopefully you guys can see what we can see here. If we look at the markets, you can see that the dotted line is where the decision came out, and we can see the first couple of minutes, not much going on. We've had the S&P moving slightly, but because the market is exactly as expected, this is what we said. We're not going to see a massive move to the upside. We're not going to see a massive move to the downside, which is really good. Now we need to digest the report. I'm going to go through the report. I've got that open just now, which I've just downloaded. It took me a couple of minutes to download it because their website kept crashing on me. But we've got that. I'm not expecting a massive move right now. Now we need to look to the press conference, which is coming up in the next 25 minutes. We're going to cover that whole press conference here. So we've got the announcement, 50 basis points, which is really good. Let's head over to Bloomberg to see what they're saying on the news, and then we'll go through the PDF to take a look at any further actions or comments made on the PDF.
We're all looking for it. The first one going all the way back to the year 2000. Plans to wind down the balance sheet. That will begin in June at a monthly pace of $47.5 billion. That will step up over the next 3 months to $95 billion. Worth pointing out, that is twice the pace, double the pace basically once they get to $95 billion than the pace we were running at last time around when balance sheet runoff started. When was that, Bramo? 2017, 2019?
Something
it's
like
quicker.
Yeah.
Much quicker.
Faster. But they've got a lot further to go. And a lot of people take a look at the labor market. They see a lot more momentum. I do want to go back, though, to this idea, this dueling objective, where they're talking about getting inflation down. What is the time frame, as Mike was saying, to get back to 2%? Is it okay if it happens in 2035?
Well, I think ultimately right now, they don't have to choose between growth and inflation. They can focus on inflation.
Let's go through the PDF. Let's see if we can see if anything interesting was said here in the PDF. The Board of Governors of the Federal Reserve voted unanimously to raise the interest rate paid on reserve balances to 0.9%. Fine. So you can see here, effective May the 5th, FOMC Market Committee directs the desk to undertake from 0.75% to 1%. So that's our 50 basis point hike as expected. Let's keep going, see if there's anything they say here. Normally they don't say too much in the statement, but Jerome Powell will, of course, speak later on. There you go. Nothing major. In related action, the Board of Governors of the Fed Reserve System have voted unanimously to approve a 0.5 percentage point increase in the primary credit rate to 1%. Fine, cool. Covered that off. That's good. So let's go back to see what markets are reacting to. We can see a little bit of red candlesticking going on here by the S&P, which is on the right-hand side. Remember, I'm showing you the S&P on the right-hand side. I'm showing you Bitcoin on the left-hand side. We're looking at the minute candle, so yes, they're moving quickly, just so we can see what's going on here in the market. You can see Bitcoin kind of had a little run-up up to 39,200, and now it's sitting back at 38,904. Nothing. This is just traders playing a little bit of games, but 50 basis points was all but priced into the market. It won't get spooked by that. Jerome Powell's going to have to come out and say something a bit more worrying to rug pull us. So we're going to have to listen in to see if that's okay. Everybody can hear me good? Good stuff. Welcome, TVid, new subscriber. Guys, make sure you hit up the like button. We've got 87 of you in here. If you could all hit up that like button, hopefully YouTube recommend this video to people who need to understand that the Fed FOMC can affect crypto, right? That's how it happens. So let's cover off this decision. Let's see how it affects the markets, whether you're trading equities, whether you're trading crypto. It's important to follow this. We're going to listen to the whole press conference with us here live today for Jerome Powell. And we'll be monitoring the markets as he speaks to see what's going on. If at any point my audio cuts off, make sure you scream in the chats so I can get that fixed for you. Good to hear that you can hear my mic. Good to hear that you can hear the live stream on the TV. And the only thing we've probably not tested is, can you hear this? Can you hear the ka-ching? Because hopefully, if we don't get rug pulled, we could be setting ourselves up for a rally. And the reason I say that is the 0.5% is the first check. 0.75 would have been doom. 0.5 is okay. It's not going to be enough for us to rally. But if we can have some good comments now, it could give us a way to rally. But we need to make sure that Jerome Powell doesn't rug pull us with over hawkish statements. We don't want over hawkish statements because that can really ruin us for the next couple of weeks. Now, remember, this was something we discussed in our course member live streams. The last time on March the 16th, when we had our FOMC meeting, we know that what the Fed came out and they did a decent job, right? We monitored the minute charts, we looked at it. Jerome Powell didn't crash the market. He did a good job. And as you spoke, the market was doing okay. But the problem was in the subsequent weeks thereafter, he came out, he had numerous appearances. Fed officials, I remember Marie Daly and a few others, had some appearances on news channels and they spooked the market. So initially on the March 16th FOMC meeting, Jerome Powell came out and said he made it seem as though he'll do multiple 0.25 basis point increases. But then in his appearances in the interim, he started saying, no, we want to front load those interest rate hikes. That is what spooked the market. That is why we didn't have a nice run between then and now when we would have. We would have had a clear run rate for a nice little run, but we didn't based on that purpose. So now the market priced in 0.5%. They're going to price in 0.5 basis points again. So now the only way really Jerome Powell can spook the markets is coming out really hawkish to suggest maybe he's going to do 0.75, maybe he's going to do 1 basis point on the next meeting. Okay, but by the next meeting, we'll have more CPI data, we'll have more jobs related data, so we can see what impacts are the increases having, because it's been about 6 weeks since the first 0.25% increase, and then by the next meeting you would have had plenty of time since this 50 basis point hike. So the Fed will have plenty of data to see how effective are the interest rates at curbing inflation. Is inflation inflecting down? And that's going to be the key for what we need here. Let's flip back over to Bloomberg to see what our friends are saying there.
You walk me through how nuanced your view actually is.
Sure. Well, as I mentioned, using a cyclical adjustment for bond yields, we are now, well away from any outcome we would expect if the long-term bull market were still intact. But having said that, right, even when these long trends end, this 40-year bull market ends, we saw this when rates rose in the 60s and 70s. What happens is we tend to find we break the trend, but we then do a mean reversion and we go back down in yields. So I'm expecting that rates here are not going to go skyrocketing off into the stratosphere, but what we've done is by breaking the long-term trend, we now are probably in a protracted period, maybe 5 to 10 years, where the range on interest rates is going to be somewhere between the lows that we've had already and the highs that we're currently seeing, and that at some point, like in the 1940s and the 50s, that we will break out of that consolidation range and we will begin a generational bear market in bonds. One interesting thing to remember.
Very stable markets right now, guys. And again, that's based on the fact that this is priced in, right? You can tell. Look at this. S&P barely moving here. This is a minute chart. You expect to see some crazy candles on a piece of news like this. But so far, everything has been done based on what's been priced in. The statement was very benign, as you'd expect. It's 0.5% as people are expecting. And the markets are now waiting for Jerome Powell, which we're going to have in about 18 minutes time. So we will listen into that. Let's also look at Bitcoin. Now, I do want to show you the wider pattern on Bitcoin for those who missed my update earlier in the day. Again, you're going to have to excuse this messy chart, but this is our day-to-day chart which we work with, and it's the one we need because it's got all the data we need in it. But in essence, what we're looking to do is we want to break out from this violet pattern to the upside. And if I head on over to the 4-hourly chart, you'll see this a little bit better. And let's just bring that out. Pull that to the top side. There you go. And what we want to do is we want to start getting to the levels from this pivot point here. That's where we need to get to in terms of 42.5. So far, we got the breakout earlier today, right? You can see the candles are breaking out. But if Jerome Powell tanks the market, we're going to end up back into this wedge pattern, potentially breaking to the downside. Remember, the technical target to the downside is 33,000. The technical price target to the upside is 42.5. So hopefully we can either come and retest and carry on to the upside, or just go straight to the upside and clear through our pivot points. Obviously, we're getting some natural resistance here at 39,000. That's this pivot point here. Then we're going to see some resistance at 40,000 and then 41,659. Then we can get to 42.5, okay? But that would be the top price target for the next couple of days if we can start moving to the upside, if we get some good news or some good dovish tones from Jerome Powell. So that's what we're looking out for here. This is why we're paying such attention to these markets right now, because if Jerome Powell comes out hawkish, market's not going to like it. If he comes out dovish, the markets can use that as an excuse to start rallying. Okay, so let's switch that back over.
Near term, I'm actually fairly bullish. I think rates will come back down. We shouldn't be panicked. The Fed has been very clear. We're going to fight inflation. We're not worrying about the economy right now. So inflation fighting is priority number one, and that's the sort of environment where bonds perform well.
Scott, you've been in the Milken Conference for a while. Do you think that people generally are too bearish or too bullish in terms of their investment theses, let alone just what they're saying, their prognostications about the longer or even medium-term outlook?
Well, you know, it's really interesting, Lisa. Everybody seems to be so uncertain about the near-term future. But the longer-term view seems to be somewhat positive, if not bullish. I had a breakfast this morning with a major investor in private equity, and he was telling me he thinks, you know, we're going to have a tough go for the next 8 months or so in stocks, but ultimately we're going to come out of this.
Whilst we're listening into Bloomberg, do let me know in the comments, what are you doing in this market? Are you holding cash on the side? Are you dollar cost averaging? What are you worried about? Let me know in the comments. It'd be good to get your view on what you think about this. I mean, my view is quite clear. As a long-term investor, this is a bunch of nothing burger for me, right? Like, we know we're still in a very accommodative stance right now from the Fed. We spoke about this with our course members live. If you like my perspective and you want to check those out, ijaz.uk/member, you too can join our course member live streams, right? Where we go through these types of things 3 times a week, discuss portfolios, tokenomics, we do all that kind of stuff together with our course members. But what we were talking about today was, look, we're still in a very accommodative stance. We're still on red ball, but the market just doesn't understand it. We've printed money, super low interest rates, and that's why, you know, the markets are struggling to now get off this addiction that is the red ball hype, right? Now, the Fed have made it very clear we're going to see interest rate hikes lead all the way up to 2 to 2.5%. And they want to do that by the end of the year. Now, all that has changed was initially we thought they'd do it very gradually and maybe even back end, right? So do 0.25, 0.25, 0.25 and finish the last bit off in 0.5. But in the midst between March the 16th and this meeting, Jerome Powell changed his stance and said he's going to front load them. And I suspect he may talk about that again today, which is he wants to front load with the heavier hikes, the 0.5% hikes, right? We've not had a 50 basis point hike in many years. He may want to front load those. Now, the risk with front loading them, and the reason why the market is tentative about this / nervous, is you will not get what is called a soft landing. A soft landing is the same as saying if you're in somebody's car and they break the brake pedal too hard to slow the economy down, you get that really jerky reaction, right? You want that soft landing. You rather than you just do it delicately, do it gradually, and brake successively harder as you get closer to stopping, right? You don't go really hard and then slow down on your press on the gas pedal. That is what you call a bit of a harsh landing. People don't want a rough landing, they want a soft landing. That's what this whole conversation is around the market, and that's why we're seeing risk rotate off. When risk rotates off, people move out of highly speculative, riskier assets such as crypto. And we know crypto is the most volatile asset class there is. It's why we're ultimately in it, right? And why we even play around with altcoins. But that is what it is. It's part of the environment we invest in. We need to understand that the reality is even when we get to 2.5%, it's neutral. It's not even a tightening of a policy. Tightening of the policy starts beyond then, and then we'll see how the market reacts, right? Next year, how does it react to 3%? How does it react to 3.5%? That's what we want to see. And also, how does it react to the other thing which we've not spoken about, which is the quantitative tightening? Remember, we might hear about that in the press conference, their plans around the quantitative tightening. Are they going to shrink the balance sheet really quickly and aggressively? Because if they do, that could tank the market as well. Remember, the market's probably expecting about $30 to $35 billion of shrinkage a month, but the Fed could come out and spook the markets and do 95 billion a month, right? And again, that number plus how often they're going to do it can spook the markets as well. So we need to listen in for all of these things in the next 10 minutes or so when Jerome comes out for his Q&A session. And this is always bound to move the market when he speaks. Let me know in the comments what you're doing, and I'll cover that off in a second.
Is that they've got to bring demand down to a supply-constrained global economy. And the only place they can increase supply, actually,
we've got Mark Eisler just buying Coty as everything else is overvalued, and Coty is the sleeping giant as it's more of a traditional finance play. Jed Testnet live today too. Yes, I heard that about the Jed Testnet. We do cover Coty quite a bit on this channel actually. Again, something which I agree with you is hugely undervalued, partially because the price was far higher before they were the official issuer of the Jed token with the ADA network. So since announcing that, the price has just gone down, and we know why, because the wider market is down. Emmanuel, great to be here. Thanks, Ijaz, for keeping us in the loop. Oh, man, forever. Indeed. Oh, man. Ryan, I have a delta neutral position out on my crypto holdings to mitigate risk. Fair enough. That's a smart way to do stuff, to mitigate some of that risk. That means the dollar will increase for avocado. I don't know who that is. What's that said? Darwish, still bullish on Phantom? Absolutely. Let's see what anybody else says. AD, who's one of our course members, who's actually a pilot, says, I know well about soft and hard landings. Absolutely. You didn't need my really bad analogy. Shizzy, good to see you. They said they're shrinking 45 billion. Is that on the statement? Let's see if that's on the statement. Let's have a look. See if I can find that section in a bit. Let's see if that's here. So what they've said is, take a look. Not very clear there. We'll see if the news cover that off shortly, but it's not super clear right now from what that statement is saying in terms of their shrinkage. So we'll see if they cover that off in the Q&A in terms of that. So let's see if they cover that off in the Q&A. That's definitely an important point, Shizzy. So we want to keep an eye on that. How much are they going to shrink the balance sheet by? Okay, so let's also see what the markets are doing. Let's flip on over to the charts. We'll head on over back to Bloomberg when ready. We can see markets kind of ticking down now. So remember, this is what we were leading up to the meeting, a little bit of positivity, and we're kind of just falling down slightly. This is nothing, guys. Remember, this is a minute chart. It looks more exaggerated than it is. We zoom out to the daily. These are not big movements. I mean, Bitcoin sitting at, as we speak, sitting at 38,728. Not a big deal at all here on the Bitcoin. We opened up today at 39,064. So $200-$300 movement for Bitcoin is nothing for an event like this, right? So let's see if we can bring back Bloomberg to see if they're saying anything interesting over the suit. Suits are saying.
Do not see us returning to the world we left in 2019. Even Jay Powell in March at our NABE meeting, he said, no one is sitting around and waiting for the world that we were in to come back anytime soon.
That said, they're still looking for that 2% inflation rate. They reiterated that in their statement. And Tom Porcelli over to RBC had this to say. He said he wants to understand whether Powell wants to get that 2% inflation target before he stops raising rates, because if he does, then funds will be meaningfully higher than what most folks seem to think at the moment, and recession will be upon us. Do you think, Diane, that he wants to see, that Jay Powell wants to see 2% inflation before he stops raising rates?
I do. And I think that's because of the environment we're in. We do have some things that are an offset. A strong dollar is not the situation we had in the 1970s when the dollar was depreciating. But we've got a global inflation environment, and central banks around the world has been slow on the uptake because of the pandemic.
Yep, looks like we've got a 45 billion. Somebody fact check me if you can find this as well. But it looks like 45 billion first shrinkage starting in June. So they're not starting that immediately as well. This is good. This is pretty dovish, guys. It's not as aggressive as they could have been. Remember, their cap could be like 95 billion. So they're starting at about 45 billion. It's not super weak. It's not 30 billion, right? Just like it's not 0.25% interest rate hike. It's kind of in the middle. You're going to have a whole bunch of people that want it more dovish. And trust me, you're going to have a lot of people who say, this is not enough from the Fed. You need to do more to curb inflation. And obviously, investors in the market want them to do less. And the average layperson out there who are feeling it in their grocery bills and the rest of it, they're going to be feeling that too, right? They're not going to want inflation. They want inflation curbed. So this is a natural balancing board that Jerome Powell and the Fed have to always balance. Nobody's going to be happy all the time. But the reality is, when you zoom out, there's still $1 trillion on the balance sheet. I mean, what is it? A multiple $1 trillion on the balance sheet. Crazy, unprecedented printing. That needs to be reduced. And we're still in a very accommodative stance with very low Fed funds rate. So, not much to worry about there in terms of the longer run there. Let's take a look at some of your comments. Ivan says, come on, Phantom. I know you can. So any thoughts on Dot versus Atom? Yes, we can look at those in probably a separate stream, not in this one. Wackers, hello, driving and listening. Thanks for sharing anytime. Marco, is now the good time to stock up? I mean, definitely not, right? You got to wait until Fed Jerome Powell comes out. We got 5 minutes. He's the man with the power. He's the man that can crush markets. So you gotta wait for him to come out. Any news or any views about ApeCoin, Tufel? Not particularly. I've covered that off in a previous video. Go check on my channel. I've made a video on ApeCoin. I look at the tokenomics as well. Right now, I'm not catching it on Euphoria. If it comes down or has a crash when people start losing faith in it at some point, I'll reevaluate it at that point. But right now, I'm not chasing the green on ApeCoin. K9, I'm watching you live for the first time. Welcome, K9. Have you watched any other videos outside of the lives? Let us know. Let's see. We've got 5 minutes before the Jerome Powell press conference. If you need to go get... if you want to go and get a coffee or a tea, go do that, because Jerome Powell can waffle on. So we need to listen to anything, because even up to the last minute, he could say something which mess up the market. So we'll cover it off in detail, and then we'll do a summary for everybody as well, so that we can summarize it all in one take and summarize what I'm doing in the markets. So guys, all of you in here, please do smash up the like button, guys. Hit that like button so more people can discover this stream. We can build out this community, because the whole aim behind this community, and thank you for joining this live stream, is we want to create an environment where people can invest in crypto in a sustainable, pragmatic way. There's way too many channels out there that are covering crypto, that are talking about investing in high leverage, 25x, 100x trades, technical analysis, Fibonacci extensions, this pattern, that pattern. They never talk about the macroeconomics. And what I'm dedicated to doing here is, I've been an ex-banker trading at an investment bank, a very big US investment bank, and I know all the trading techniques. I've been there on the floor. I know how institutions do it. I know all the chart patterns. I know all the techniques. That's not a problem. The technicals are not a problem. But it's bringing that macroeconomic element, the fundamentals, and tying that in with the technicals that will allow you guys who are new to crypto, who are new to investing, to build that holistic mindset. So if you like that perspective, make sure you hit subscribe. Make sure you watch some of the other videos we've been posting here on this channel, and do be part of the community. We've got a Discord server as well, so do head into the Discord as well. It'd be good to see you guys in there. It's completely free, public Discord server for everybody to join.
Lyndon Johnson and Nixon to continue to allow inflationary pressures to build to keep the economy moving. And so I believe that the Fed's independence is being more challenged today than it has been in generations. And the chair knows that, the committee knows that, and they are being more reactive to the political pressure than they might have been under a Volcker or a Greenspan or a Yellen era.
And Diane, does that resonate with you at all?
So I would do another little nuance on it. I think that, first of all, inflation affects 100% of people. And even though unemployment is absolutely horrific and extremely hard, it only affects a few percent of people. And so inflation is always a big...
Very interesting. We got a bit of a V bounce here on equities, and Bitcoin doing the same. See how it's following? It waits for the markets to decide which way it's moving. You see the higher volumes, obviously, on the S&P, and then you're seeing kind of crypto try to follow the same pattern. Got a nice little bounce here from the S&P as they start to digest the news. And again, this is just sideways action. This is just traders. When we zoom out to the daily, this is a bunch of nothingness. We're going to see now if Jerome Powell can start to really move the markets. He's literally due to speak any moment now, so we'll make sure we flick over to that. We've got the live stream set up, so we can cover that and do a live reaction to what he's doing and what he's saying. We'll be able to watch the charts whilst he's speaking as well. So let's keep this in mind. I mean, we're sitting here at 38,900. It's not a bad place to be on Bitcoin. Again, if I come back out and zoom out and show you this chart, this is not a bad place to be. You're on the breakout from a descending channel. You've got 2/3 technical likelihood of breaking to the upside. So it just depends on what Jerome Powell says. If Jerome Powell can send this back down towards 33, not immediately, I don't think, but he can send it on the direction to that over the next couple of weeks. It could just be ugly and start heading towards 33, or he can help us just at least stay sideways and try to work our way back up to 42.5. So that's definitely what we want to listen to. We've got what we expected in this meeting, or from the statement, guys. 0.5% increase in the interest rate for those of you who are just joining this live stream. As expected, 100% of the market is priced in the double rate hike. Yes, we haven't had one for many, many years, but the market knew about it. They got the idea and they priced it in. Okay, good. And we got the balance sheet shrinkage. But again, it's not starting straight away in May. It's going to start in June. It's going to start at about $45 billion, which again is far less than what he could have done. He could have done $95 billion and rug pulled the market. So on a spectrum of, super weak to super aggressive, he's sitting there at about, mid. He's about mid, 40%, 50% kind of level. He could go far more aggressive, and the market should be thankful that he's not doing that, right? Because that could be a complete and utter rug pull. Let's go take a look to see if Bloomberg are now ready. They look like they're trying to
a little bit, perhaps, maybe, although we don't know for sure. Mike McKee is in the room. He's going to get a question, I'm sure, at some point. Going into it then, your equity market of 0.6% on the S&P 500, on the Nasdaq up around 0.15%. Some big moves out there in the bond market over the last couple of months. Today, just a bit of a bid at the front end. Yields coming in a couple of basis points on a 2-year, let's call it 276, on a 10-year in a basis point to 296. Chairman Powell into the room, stepping up to the lectern. Here he is.
Nice to see everyone in person for the first time in a couple of years.
Oh, man.
Before I go into the details of today's meeting, I'd like to take this opportunity to speak directly to the American people. Inflation is much too high, and we understand the hardship it is causing, and we're moving expeditiously to bring it back down.
Everybody here okay?
We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.5 percentage point and anticipates that ongoing increases in the target rate for the federal funds rate will be appropriate. In addition, we are beginning the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. After expanding at a robust 5.5% pace last year.
He's not even said anything yet. He just said inflation is much too high, which we know.
Continued to expand briskly. The labor market has continued to strengthen and is extremely tight. Over the first 3 months of the year, employment rose by nearly 1.7 million jobs. In March, the unemployment rate hit a post-pandemic and near 5-decade low of 3.6%. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. Employers are having difficulties filling job openings, and wages are rising at the fastest pace in many years. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 6.6%. Excluding the volatile food and energy categories, core PCE prices rose 5.2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. Disruptions to supply have been larger and longer lasting than anticipated, and price pressures have spread to a broader range of goods and services.
Okay, that's not great.
The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to further exacerbate supply chain disruptions as well. Russia's invasion of Ukraine is causing tremendous loss and hardship, and our thoughts and sympathies are with the people of Ukraine. Our job is to consider the implications for the U.S. economy, which remain highly uncertain. In addition to the effects on inflation, the invasion and related events are likely to restrain economic activity abroad and further disrupt supply chains, creating spillovers to the U.S. economy.
Interesting.
Restoring price stability. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.5 percentage point and stated that it anticipates that ongoing increases in the target range will be appropriate. We also decided to begin the process of reducing the size of our balance sheet, which will play an important role in firming the stance of monetary policy. We are on a path to move our policy rate expeditiously to more normal levels, assuming that economic and financial conditions evolve in line with expectations. There is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings. We'll make our decisions meeting by meeting as we learn from incoming data and the evolving outlook for the economy. And we will continue to communicate our thinking as clearly as possible.
Again, I don't think that's going to spook the markets too much. Market expects another 0.5.
Tools to bring inflation back down to our 2% goal. With regard to our balance sheet, we also issued our specific plans for reducing our securities holdings. Consistent with the principles we issued in January, we intend to significantly reduce the size of our balance sheet over time in a predictable manner by allowing the principal payments from our securities holdings to roll off the balance sheet, up to monthly cap amounts. For Treasury securities, the cap will be $30 billion per month for 3 months and will then increase to $60 billion per month. The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities, and to the extent that coupon securities are less than the monthly cap, Treasury bills. For agency mortgage-backed securities, the cap will be $17.5 billion per month for 3 months and will then increase to $35 billion per month. At the current level of mortgage rates, the actual pace of agency MBS runoff would likely be less than this monthly cap amount. Our balance sheet decisions are guided by our maximum employment and price stability goals, and in that regard, we'll be prepared to adjust any of the details of our approach in light of economic and financial developments. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well-positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
Guys. That's the bit we're going to listen to the live
We at the
questions.
Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Yo, guys, hit up the likes. We're going to watch all these questions. Let's have some good ones, please. asking, like, how
Nick
much
Timmeros of the Wall Street Journal. Chair Powell, the unemployment rate at 3.6% in March is now essentially at the level that the committee had expected would prevail over the next 3 years, and at the bottom end of FOMC participants' projections for the longer run rate that you submitted in the projections at the last meeting. How has your outlook for further declines in the unemployment rate changed since March? What does this imply for your inflation forecast? And how has your level of confidence changed with regard to the feasibility of slowing hiring without pushing the economy into recession? Thanks.
Thank you. So you're right. 3.6% unemployment is just about as low as it's been in 50 years. And I would say that I expect, and committee members generally expect, that we'll get some additional participation. So people will be coming back into the labor force. We've seen that, particularly among prime age people. And that will, of course, tend to hold the unemployment rate up a little bit. I would also expect, though, that job creation will slow. Job creation has been at more than 500,000 per month in recent months, very, very strong, particularly for this stage of the economy. And so we think with fiscal policy less supportive, with monetary policy less supportive, we think that job creation will slow as well. So it is certainly possible that the unemployment would go down further. So I would expect those to be relatively limited because of the additional supply and also just the slowing in job creation. Implications for inflation, really the wages matter a fair amount for companies, particularly in the service sector. Wages are running high, the highest they've run in quite some time. And they are one good example of, or good illustration, really, of how tight the labor market really is, the fact that wages are running at the highest level in many decades. And that's because of an imbalance between supply and demand in the labor market. So we think through our policies, through further healing in the labor market, higher rates, for example, of vacancy filling and things like that, and more people coming back in, we like to think that supply and demand will come back into balance and that therefore wage inflation will moderate to still high levels of wage increases, but ones that are more consistent with 2% inflation. That's our expectation. Your third question was?
Your level of confidence that you can slow hiring without pushing the economy into a downturn.
So I guess I would say it this way. There's a path. There's a path by which we would be able to have demand moderate in the labor market and therefore have vacancies come down without unemployment going up, because vacancies are at such an extraordinarily high level. There are 1.9 vacancies for every unemployed person, 11.5 million vacancies, 6 million unemployed people. So. And we haven't been in that place on the vacancy, sort of the vacancy unemployed curve, the Beveridge curve. We haven't been at that sort of level of a ratio in the modern era. So in principle, it seems as though by moderating demand, we could see vacancies come down, and as a result, and they could come down fairly significantly, and I think put supply and demand at least closer together than they are. And that would give us a chance to have get inflation down, get wages down, and then get inflation down without having to slow the economy and have a recession and have unemployment rise materially. So there's a path to that. Now, I would say I think we have a good chance to have a soft or softish landing or outcome, if you will, and I'll give you a couple of reasons for that. One is households and businesses are in very strong financial shape. You're looking at excess savings on balance sheets, excess in the sense that they're substantially larger than the prior trend. Businesses are in good financial shape. The labor market is, as I mentioned, very, very strong. And so it doesn't seem to be anywhere close to a downturn. Therefore, the economy is strong and is well positioned to handle tighter monetary policy. But I'll say, I do expect that this will be very challenging. It's not going to be easy. And it may well depend, of course, on events that are not under our control. But our job is to use our tools to try to achieve that outcome, and that's what we're going to do.
Steve. Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You talked about using 50 basis point rate hikes or the possibility of them in coming meetings. Might there be something larger than 50? Is 75 or a percentage point possible? And perhaps you could walk us through your calibration. Why 1 month should we, or one meeting should we expect at 50? Why something bigger? Why something smaller? What is the reasoning for the level of the amount of tightening? Thank you.
Sure. So 75 basis point in an increase is not something the committee is actively considering. What we are doing is we raised 50 basis points today, and we've said that, again, assuming that economic and financial conditions evolve in ways that are consistent with our expectations, there's a broad sense on the committee that additional 50 basis point increases should be on the table for the next couple of meetings. So we're going to make those decisions at the meetings, of course, and we'll be paying close attention to the incoming data and the evolving outlook, as well as to financial conditions. And finally, of course, we will be communicating to the public about what our expectations will be as they evolve. So the test is really just, as I laid it out, economic and financial conditions evolving broadly in line with expectations. And, I think expectations are that we'll start to see inflation.
Just very quickly, guys, markets. S&P reacting pretty well to that. Let's have a look. Let's see how it gets on. We've just kind of fallen quite low and then back high again. It's pretty steady. Let's get back to the stream.
Either reaching a peak or flattening out. We'll want to know more than just some evidence. We'll want to really feel like we're making some progress there. But I mean, we're going to make these decisions, and there'll be a lot more information. I just think we want to see that information as we get there. It's a very difficult environment to.
Bitcoin back above 39,000, 39,100 for Bitcoin.
And around the world. So, we're leaving ourselves room to look at the data and make a decision as we get there.
I'm sorry, but if inflation is lower 1 month and the unemployment rate higher, would that be something that we would calibrate towards a lower increase in the funds rate, or
I don't think 1 month is not no 1 month's reading doesn't tell us much. We'd want to see evidence that inflation is moving in a direction that gives us more comfort. As I said, we've got 2 months now where core inflation is a little lower, but we're not looking at that as a reason to take some comfort. I think we need to really see that our expectation is being fulfilled, that inflation, in fact, is under control and starting to come down. But it's not like we would stop. We would just go back to 25 basis point increases. It'll be a judgment call when these meetings arrive. But our expectation is if we see what we expect to see, then we would have 50 basis point increases on the table at the next two meetings.
Thanks. Let's go to Colby.
Thank you. Colby Smith from the Financial Times. Given the expectation that inflation will remain well above the Fed's target at year-end, what constitutes a neutral policy setting in terms of the Fed funds rate? And to what extent is it appropriate for policy to move beyond that level at some point this year?
So, neutral. When we talk about the neutral rate, we're really talking about the rate that neither pushes economic activity higher nor slows it down. So it's a concept, really. It's not something we can identify with any precision. So we estimate it within broad bands of uncertainty. And the current estimates on the committee are sort of 2% to 3%. And also, that's a longer run estimate. That's an estimate for an economy.
SPY is going, guys. SPY is gone now. It's now at a higher point than before the meeting started. So statement was here. Jerome Powell started speaking here. And now the SPY is gone. Bitcoin now 39,269. Let's get back to Powell.
Of neutral. But we know that there's not a bright line drawn on the road that tells us when we get there. So we're going to be looking at financial conditions, right? Our policy affects financial conditions, and financial conditions.
The markets like the fact that he's not considering 75 basis points. He said that clearly. That's what the market is reacting to, in case I wasn't clear.
Appropriately. And then we're going to be looking at the effects on the economy. And we're going to be making a judgment about whether we've done enough to get us on a path to restore price stability. It's that. So if that path happens to evolve levels that are higher than estimates of neutral, then we will not hesitate to go to those levels. We won't. But again, there's a sort of false precision in the discussion that we as policymakers don't really feel. You're going to raise rates and you're going to be kind of inquiring how that is affecting the economy through financial conditions. And of course, if higher rates are required, then we won't hesitate to deliver them.
Neil. Thanks, Chair Powell. Neil Irwin with Axios. Do you see evidence that inflationary psychology is changing, that in areas like workers' wage demands, businesses' willingness to raise prices, do you see evidence that there is a psychological shift going on inflation? Thanks.
So we don't really see strong evidence of that yet, but that does not in any way make us comfortable. I think if you look at short-term inflation expectations, they're quite elevated, and you can look at that and say, well, that's because...
Guys, SPY really is running here. We've got SPY going here.
You can look at that, and I think that's a fair description of the picture, but it's really about the risks. We don't see a wage price spiral. We see that companies have the ability to raise prices, and they're doing that, but there have been price shocks. So I just think it takes you back to the basic point was that we know we need to expeditiously move our policy rate up to ranges of more normal, neutral levels, and we need to look around and keep going if we don't see that financial conditions have tightened adequately or that the economy is behaving in ways that suggest that we're not where we need to be. So you don't see those things yet, but I would say there's no basis for feeling comfortable about that. It's a risk that we simply can't run that risk. We can't allow a wage price spiral to happen, and we can't allow inflation expectations to become unanchored. It's just something that we can't allow to happen, and so we'll look at it that way.
Gina. Great. Thanks, Chair Powell. Gina Smilik with the New York Times. You mentioned in the statement both the upside risks to inflation from Russia and China. Obviously, those are very much supply shocks rather than demand side. And I wonder what you meant to convey by adding them. I wonder what you meant to convey by adding those.
Well, so our tools don't really work on supply shocks. Our tools work on demand. And to the extent we can't affect really oil prices or other commodity prices or food prices and things like that. So we can't affect those. But there's a job to do on demand. And that you can see that in the labor market where demand is substantially in excess of supply of workers. And you can see it in the product markets as well. But I guess I'm just pointing out that a couple of things. For both the situation in Ukraine and the situation in China, they're likely to both add to headline inflation, and people are going to be suffering from that. You know, people almost suffer more from food and energy shocks but even though they don't actually tell us much about the future path. So, but the second thing is that they're both capable of preventing further progress in supply chains healing, and so, or even making supply chains temporarily worse. So they're going to weigh on the process of global supply chain healing, which is going to affect broader inflation too. So in a way, they're two further negative shocks that have hit really in the last, 60 days, 90 days.
Victoria.
Hi, Victoria Guida from Politico. I want to follow up on that because you all have obviously highlighted that there are both supply and demand issues at play in inflation. And I'm just wondering, if these supply chain issues continue because of Russia, because of China, or just because these things take a while to work out, does getting back down to your 2% mandate require that these supply chain issues get resolved, since you can only handle the demand side, as you said, or will you have to crimp demand maybe even further if the supply chain issues don't resolve themselves in order to try and get inflation back down to where you want it to be?
So, I'll just say for now, we're focused on doing the job we need to do on demand, and there's plenty to be done there. Again, if you look at it, it's essentially almost 2-to-1 job vacancies to unemployed people. There's a lot of excess demand there. More than 5 million more employed plus job openings than there are the size of the labor force. So there's an imbalance there that we have to do our work on. It's a very difficult situation if you can't, you would look at core inflation, which wouldn't include the commodity price shocks. And that's one of the reasons we would tend to focus on that, because we can have more of an effect on that. But it would be a very difficult situation. I mean, we have to be sure that inflation expectations remain anchored, and I mean that's part of our job too. So we'd be watching that carefully, and it puts any central bank in a very difficult situation.
Howard Schneider with Reuters, and thanks, and nice to be back. So two questions, one quick one. You cited the 1.9 to 1 figure so often now. I got to ask you, what would be a good figure there? What would you like to see that come down to think that you're at sort of a non-inflationary vacancy to unemployed rate? And secondly, on help from inflation, how much are you counting on wealth effects through stock market channels? Equity markets broadly down quite a bit since late fall, first of the year.
Look at this, guys. Look at that. S&P is gone. It's gone. Bitcoin 39,622. Market is running. Market is happy.
Ratio. We don't have a goal in mind. There's no specific number that we're saying we got to get to that. It's really you've got to get to a place where the labor market appears to be more in balance, and that depends not only on the level of those things. It depends on how well the matching function in the labor markets are working, because the longer these expansions go on, you can get very efficient with all of that, and the beverage curve shifts out, and that also tends to help. So there isn't a specific number. I will say we were at, I think when we got to 1-to-1 in the late teens, we thought that was a pretty good number. But again, we're not shooting for any particular number. What we'd like to see is progress, but we're not really looking at that. That's an intermediate variable. We're looking at wages, and we're looking at ultimately inflation. So there are a bunch of channels through which policy works. You can think of it as interest-sensitive spending. And then you can think of another big one as asset values broadly, and there are big models with a lot of different channels that are related to that. We don't focus on any one market, the equity market or the housing market, or we focus on financial conditions broadly. So we wouldn't be targeting any one market, as you suggest, for going up or down, or taking a view on whether it's at a good level or a bad level. We just would be looking at very broad measures of financial conditions, all the different financial conditions indexes, for example, which include equity, but they also include debt and many other things, credit spreads, things like that too.
Rachel.
Just very quickly, markets are doing well so far. 39,750 for Bitcoin, ETH just shy of 3,000. You've got ADA back at 86 cents, Phantom 83 cents. Feels like a long time ago. It sat at 65 cents. It was just days ago, guys. Solana $91 on Solana, Algorand 69 cents. Markets looking pretty interesting. Luna $87.
So, the first thing to say is that we understand. And some of us are old enough to have lived through high inflation, and many aren't. But it's very unpleasant. It's just something people don't, when they experience it for the first time. You're paying more for the same thing. If you're a normal economic person, then you're probably don't have that much extra, to spend, and it's immediately hitting your spending on groceries, on gasoline, on energy and things like that. So we understand the pain involved. So how do you get out of that? And it's our job to make sure that inflation of that unpleasant high nature doesn't get entrenched in the economy. That's what we're here for. One of the main things we're here for, perhaps the most fundamental thing we're here for. And the way we do that is we try to get supply and demand back in sync with each other, back in balance, so that the economy is under less stress and inflation will go down. Now, the process of getting there involves higher rates, so higher mortgage rates, higher borrowing rates, and things like that. So it's not going to be pleasant either. But in the end, everyone is better off. Everyone, particularly people on fixed incomes and at the lower part of the income distribution, are better off with stable prices. And so we need to do everything we can to restore stable prices. We'll do it as quickly and effectively as we can, we think we have a good chance to do it without a significant increase in unemployment or really sharp slowdown. But ultimately, we think about the medium and longer term, and everyone will be better off if we can get this job done. The sooner the better.
Thank you, Edward.
Thank you, Chair Powell. Edward Lawrence with the Fox Business Network. So you've talked in the past about consumer spending and how that's drives the economy. Are you concerned with this high level of inflation that the consumer will stop spending, pushing us into, and what's the level of your concern, pushing us into a recession?
So the economy is doing fairly well. We expect growth to be solid this year, and we see household spending and business investment as fairly strong, even in the first quarter, which was relatively slow on some other fronts. So, and the labor market. If you look at the labor market, for people who are out of work and looking, there are lots of job opportunities. For wages are moving up at rates that haven't been seen in quite a long time. So it's a good time to be a worker looking to.
So far, so good, guys. He's not saying anything to crash the market. He's saying what we want to hear. He sounds like he's got this under control. No crazy 75 basis point hikes. He's not going to go back to 0.25. It sounds like he wants to do 0.5 until he sees that inflation is under control. And he's focused on the demand side. He obviously can't affect the supply chain. He can't do anything in terms of the supply side of inflation, but he's focused on the demand side. So he's not saying anything to spook the markets. But remember, he didn't on March the 16th either. I just tweeted that right now. On March the 16th, he said everything to make the market happy as well. But in the weeks after, he U-turns. So we've got to be cognizant of
growth this year at a solid pace, above 2%.
But we've talked with economists who have advised Democrats and Republican presidents, who both said that the Fed is so far behind the curve on inflation that a recession is inevitable.
So, and as I said, I think we have a good chance to restore price stability without a recession, without a severe downturn, and without materially higher unemployment. And I mentioned the reasons for that. So I see a strong economy now. I see a very strong labor market, for example. Businesses can't find the people to hire. They can't find them. So typically in a recession, you would have unemployment. Now you have surplus demand. So there should be room, in principle, to reduce that surplus demand without putting people out of work. The issue will come that we don't have precision surgical tools. We have essentially interest rates, the balance sheet, and forward guidance, and they're famously blunt tools. They're not capable of surgical precision. So I would agree. No one thinks this will be easy. No one thinks it's straightforward. But there's certainly a plausible path to this, and I do think we've got a good chance to do that. And our job is not to rate the chances, it is to try to achieve it. So that's what we're doing. There are a range of opinions, though, and that's only appropriate.
Steve Dorsey.
Hi. Thanks, Steve Dorsey, CBS. You mentioned earlier just now fading fiscal policy. Do you feel that the Fed has been supported enough from policies at the White House and in Congress in combating inflation?
It's really the Fed that has responsibility for price stability, and we take whatever arrives at the Fed in terms of fiscal activity. We take it as a given, and we don't evaluate it. We don't. It's not our job, really. We don't have an oversight function there, and we look at it as our job given all the factors that are happening, to try to sustain maximum employment and price stability.
Guys, if you're happy that the market is green, Bitcoin up 5%. You got Phantom up 10% right now. Smash up the likes, guys. So good to have so many of you new faces here on this live stream. If you appreciate the fact that we're covering this off, hit up the like button. I'm keeping myself quiet so you don't miss out on what Jerome Powell has to say. You hear enough of me every day with old man.
Then maybe I can, give other people advice. Right now, we need to focus on doing our job, and I'll stick to that. Stick in our lane.
Okay, Steve Matthews.
Steve Matthews with Bloomberg News. A number of your colleagues have said that rates will need to go above neutral into a restrictive territory to bring down inflation. One, do you agree with that? And two, you recently spoke in great praise of Paul Volcker, who had the courage to bring inflation down with recessions in the 1980s. And while it's certainly not your desire, and the soft landing is the big hope of everyone, would this FOMC have the courage to endure recessions to bring inflation down if that were the only way necessary?
So I think it's certainly possible that we'll need to move policy to levels that we see as restrictive as opposed to just neutral. We can't know that today. That decision's not in front of us today. If we do conclude that we need to do that, then we won't hesitate to do it. I'll say again, there's no bright line, that you're stepping over. You're really looking at what our policy stance is and what the market is forecasting for it. You're looking at financial conditions and how that's affecting the economy and making a judgment. We won't be arguing about whose model of the neutral rate is better than the other one. It's much more about a practical application of our policy tools. And we're absolutely prepared to do that. It wouldn't hesitate if that's what is taken. So I am, of course, who isn't an admirer of Paul Volcker? I shouldn't be singled out in this respect, but I knew him just a little bit and have tremendous admiration for him. And I would phrase it this way. He had the courage to do what he thought was the right thing. That's what it was. It wasn't a particular thing. It was that he always did what he thought was the right thing. If you read his last autobiography, that really comes through. So that's the test. It isn't will we do one particular thing. I would say we see restoring price stability as absolutely essential for the country in coming years. Without price stability.
He's referring to Paul Volcker, who he praises quite a bit, he admires him quite a bit. But this was somebody that, in order to curb inflation in previous administrations, he sent the U.S. into a recession. So he's asked, would you do the same? And he's saying, I wouldn't hesitate to if I needed to. Recorded
history. And in the last 2-3 years, you had the benefits of this tight labor market going to people in the lower quartiles. And it was, racial wealth and income, not wealth, but income gaps were coming down, wage gaps. So it's a really great thing. We'd all love to get back to that place. But to get back to anything like that place, you need price stability. So we've been hit by historically large inflationary shocks since the pandemic. This isn't anything like regular business. We have a pandemic. We have the highest unemployment, since the Depression. Then we have this outsized response from fiscal policy and monetary policy. Then we have inflation. Then we have a war in Ukraine, which is cutting the commodity patch in half. And now we have these shutdowns in China. So it's been a series of inflationary shocks that are really different from anything people have seen in 40 years. So we have to look through that and look at the economy that's coming out the other side. And we need to somehow find price stability out of this. And it's obviously going to be very challenging, I think, because you do have, numerous supply shocks, which are famously difficult to deal with. So I guess that's how I think about it.
Hey, Chris.
Thank you. Chris Rugaber and Associated Press. Earlier, you just said that if necessary, I think were the words, that you would, or if it turned out to be necessary, or you said it's possible that we'll need to move policy to restrictive levels. Given where inflation is and the hot economy is, or certainly the hot labor market as you described it, why still the hesitation? I mean, shouldn't it be, what else do you need to see in order to determine that? Wouldn't the Fed naturally be looking to go to a restrictive level at this point? Thank you.
So if I said necessary, I meant to say appropriate. We're not going to be erecting a high barrier for this. It's more if we think it's appropriate. The point is we're a very long way from neutral now. We're moving there expeditiously, and we'll continue to do so. And we can't make that decision really today. The decision about how high to go will be on the table to be made when we reach neutral. And, I expect we'll get there expeditiously, as I've mentioned. So it's not that we don't want to making that decision today wouldn't really mean anything. But I'll say again, if we do believe that it's appropriate to go to those levels, we won't hesitate.
Thanks. Mike McKee.
Mike McKee from Bloomberg Television and Radio. The balance sheet, why did you decide to wait until June 1st to begin letting securities roll off and not immediately start in the middle of this month, say? And do you have a newer or a better estimate for the monetary policy impact of letting the balance sheet decline? And then finally, I'm just curious why you felt the need to address the American people at the top of your remarks. Are you concerned about Fed credibility with the American people?
So why June 1? It was just pick a date, and that happened to be the date that we picked. It was nothing magic about it. It's not going to have any macroeconomic significance over time. We just picked that. Sometimes we publish these calendars on the first day of the month, and that's what we're doing. I wouldn't read anything into it. In terms of the effect, I would just stress how uncertain the effect is of shrinking the balance sheet. We run these models, and everyone does in this field, and make estimates of what will be the how do you measure, a certain quantum of balance sheet shrinkage compared to quantitative easing, and these are very uncertain. I really can't be any clearer. There won't be any clearer. People estimate that. That broadly on the path we're on, and this will be taken probably too seriously, but sort of 1/4%, one rate increase over the course of a year at this pace. But I would just say with very wide uncertainty bands, very wide. We don't really know. There are other estimates that are much smaller than that, by the way, and some of you may have read about that. That's kind of a mainstream estimate. We know that it is part of returning to more normal and more neutral financial conditions, and our strategy is to set up a plan and have it operate, and really have the interest rate be the active tool of monetary policy. In terms of speaking to the American people, I feel like sometimes I want to remind us really that that's who we work for, and that it's inflation that people are feeling all over the country. And it's very important that they know, that we know how painful it is, and that we are working hard on fixing it. I thought it was quite important to do that. And
we've got Bitcoin trying to
really
break through 40,000, just sitting at 39,900, just getting a little bit of resistance at 40,000.
Do you think the Fed has a credibility problem?
No, I don't. And a good example of why would be that. So in the fourth quarter of last year, as we started talking about tapering sooner and then raising rates this year, you saw financial markets reacting, very appropriately. Not to bless any particular day's measure, but the way financial markets, the forward rate curve has tightened in response to our guidance and our actions, really amplifies our policy. It's. Monetary policy is working through expectations now to a very large extent. We've only done 2 rate increases, but if you look at financial conditions, the 2-year is at 280 now. In September, I think it was at 20 basis points, and that's all through the economy. People are feeling those higher rates already, and that shows that the markets think that our forward guidance is credible, and I think that's we want to keep it that way.
Scott Forsley, did you have your hand up? Okay. Brian, Chung.
Hi there, Brian Chung with Yahoo Finance. To expand on Steve's question about Paul Volcker, there was also a great pain that came with that as well. Higher interest rates obviously affecting households and businesses, and wondering how you kind of square what might be demand destruction. Are you already seeing that? Is the idea here to incentivize a lack of spending, to decrease consumption, to
S&P now up on session highs, up 2%. Nice move on S&P. 425 mil on S&P, much higher than when the conference started.
Where their demand is substantially in excess of supply, and what you're seeing as a result of that is prices going up and at unsustainable levels that are not consistent with 2% inflation. And so what our tools do is
Bitcoin literally just touched 40,000, just got rejected on that minute candle, but just touching on the door now.
Interest rates, businesses will invest a little bit less, consumers will spend a little bit less. That's how it works. But ultimately, getting supply and demand back in balance is what gives us 2% inflation, which is what gives the economy a footing where people can lead successful economic lives and not worry about inflation. I mean, so yes, there may be some pain associated with getting back to that, but the big pain is in not dealing over time, is in not dealing with inflation and allowing it to become entrenched.
Greg, Rob.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could take a step back and talk about, in March, the dot plot had, steady, looked like steady quarter-point rate hikes, get the funds rate up to 2% at the end of the year. Now, it seems like you're much more aggressive. So could you talk about the thinking that's behind that? Thank you.
So, look, I think what you've seen is really, I would say, last fall, in the middle of last fall, there was a time when our policy stance was still pretty much in sync with what the data were saying. If you remember, there were a couple of weak jobs reports, and inflation had actually come, month by month inflation had come down till September, a few months in a row, stayed low. And then around the end of October, we got three or four really strong readings that just said, no, this is a much stronger economy. And by the way, then with the restatement of the jobs numbers, it looked like the job market was much more even and stronger in the second half of the year. But that hadn't happened yet. Anyway, we got an ECI.
Come off the stream, guys. Just want to show you the movement here on Bitcoin. This is when Jerome Powell started speaking. Red line, big move on Bitcoin. Jerome Powell started speaking. Big move on S&P. Let's get straight back.
And so I think it became clear to the committee that we needed to adjust and adapt. And we have. Ever since then, really ever since then, we've been adapting. The committee moved by the time of the December meeting to a meeting of 3 rate increases, then to a meeting of 7 rate increases at the March meeting. And that process is going on, and it's clearly continuing. And that's why I say, and I actually mentioned this at the March meeting, that no one should look at any single SEP as sort of a real resting place for 90 days, because we're in a fast evolving situation, and that's what's happened. You can see unanimous vote today, of course, and I told you the guidance that broad support on the committee to have 50 basis point hikes on the table at the next couple of meetings. So you're right, and by the way, other forecasters have been doing the same thing. And it's just us adapting to the data and to the situation and using our tools to deal with it.
Thanks. We'll go to Nancy for the last question.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, I want to ask how you're able to balance your dual mandate, stable prices and maximum employment, especially when the unemployment rate for black workers is still roughly twice the rate for white workers.
So unemployment rates for all racial groups have come down a lot and are now much closer to where they were before the pandemic hit. So that's one thing I would say, and that's important. But the bigger point is this: I do not at this time see the two sides of the mandate as in tension. I don't. Because you can see that the labor market is out of balance. You can see that there's a labor shortage. There aren't enough people to fill these job openings, and companies can't hire, and wages are moving up at levels that would not over time be consistent with 2% inflation over time. And of course, everyone loves to see wages go up, and it's a great thing, but you want them to go up at a sustainable level, because these wages are to some extent being eaten up by inflation. So what that really means is, to get the kind of labor market we really want to get, we really want to have a labor market that serves all Americans, especially the people in the lower income part of the distribution, especially them. To do that, you've got to have price stability. And we've got to get back to price stability so that we can have a labor market where people's wages aren't being eaten up by inflation, and where we can have a long expansion, too. That's the good thing, is you can have, as we've had several of the longest expansions in U.S. history have been in the last 40 years, and that's because it's been a time of low inflation. And long expansions are good for people and good for the labor market. So that's the way I think about it. I think we, our tools work. We have to think in the medium and longer term, And I do think that the best thing for everyone is for us to get back to price stability to support really a sustained period of strong labor market conditions. Thanks very much.
Short and sweet from Chairman Jay Powell there, wrapping up that meeting from New York City for our audience worldwide on TV and radio. Let's check out the price action for you. Equities up by 2.4% on the S&P 500. On the Nasdaq up by 2.
There we have it. There we have it. That was the nice and short and sweet from Jerome Powell. That's how we like it. Sometimes he talks too long, and then the market doesn't like it. But so far, he left us in a good situation. Let's get our Donald Trump hands out, right? Let's get our... There was none of this. There was no fake news. It was all good stuff from Jerome Powell. Look what he's done. He came in when the red line started, right? This is good performance, Jerome Powell. Big move to the upside, right? Bitcoin was sitting here, 38,600, now touching 40,000. This is good. Good work. S&P up. You got Phantom up almost 12%. If I show you the Phantom chart here, guys, big moves here from Phantom to the upside. You can see here, this is the hourly chart, and we're now getting to the 84 cents mark where there's a little bit of resistance. If Phantom can get above that and hold that level, that's going to be a really good feather in the cap in order for this to start recovering back to 96 cents. So a good overall meeting by Jerome Powell. We're going to jump off this live stream shortly now, because what I'm going to do is I'm going to record a summary for those of you who weren't able to watch, or you just want to recap and watch the summary. So I'm going to wrap up everything in a summary for you. We'll also cover off what's going on in the markets. I'll look at some technical levels on Phantom and Bitcoin and a few others as well. But overall, good. I mean, we've got the 50 basis point interest rate hike, which, you know, market had all but priced in. We've got the balance sheet reduction, 45 billion to start from the 1st of June. No particular reason he's starting from the 1st of June. He's not actively considering 75 basis points. I think that was the real one where the market really just went pew once he said that, because that's huge. Because remember, going into this meeting, the market priced in 50 basis points. But then what are you nervy about, right? You're nervy about the quantitative tightening, and you're worried about a potential 0.75% and then a 1%, right? But if he's not even thinking about 75 basis points, now the market's going, phew, because we thought maybe he'd just rug pull us with a 1% increase, you know, or 0.7 and then 0.7 or something like that. So that's why the market is pretty happy right now. Look, at the end of the day, he kept it realistic, right? He said inflation is still much too high. He said the labor market is still very tight, and he needs to deal with the plenty that there is to deal with on the inflation on the demand side. He still looks at the job openings, and he looks at the imbalance in the labor market, and he wants to address that. And that makes sense, right? He's at the end of the day, look, we're investors and we want Jerome Powell to do what's good for the markets, but that's not his job. His job is to the American people, and that is why he started off by addressing the American people to say inflation is still very much too high and the labor market is still very tight. So overall, a good update from Jerome Powell. But, you know, the one thing we have to remember, I'm going to mention this in the summary as well, is he did this last time in March the 16th. We had a good press conference, right? We had a good press conference. He answered the questions correctly. His prepared statement was great. But then the Fed officials came and they U-turned. So now we need to move on to see, are we going to get these U-turns and what's happening from here? Overall, guys, we're still not even neutral. We're still in an accommodative stance, right? We're not in a restrictive stance yet. That's coming after 2.5%. So not much for the market to be worried about. The market just needs to get on with it and start rallying, because they've got at least a year before we get to neutral. At the end of the year, 2.5%. Even then, you're just at neutral, so you should still keep going. And then when things get a bit tighter and constrictive at about 3.5%, okay, fine. Maybe you then got some excuse because you're running uphill a little bit because the Fed isn't your friend. But right now, the Fed is still your friend, and things are still very, very accommodative. So markets should be buoyant on this news. We're seeing the S&P up at session highs today. We've got Bitcoin up at 5.3% at the time of recording this video. Phantom up 11.3% to 12%. We'll cover that all off in the summary and look deeper into some of these coins. As always, if you appreciate this live stream, smash up the likes and subscribe. Good to see so many new subscribers who got the alert for this live stream. Make sure you hit the subscribe button, watch some of our other videos, and join this community. Thanks for watching, guys. We'll see